Hello everyone, and welcome to Collin Investing. I am Collin, and this channel is dedicated to providing you with insights into the ever-changing world of finance and investment. We're here to break down complex topics, analyze market trends, and help you make informed decisions. Today we have a lot to cover, from major market shifts to specific company news, all in some daily analysis, all impacting potential investments. Let's dive right in. We just kicked things off with a general welcome. And that brings us to a really interesting trend developing in the global markets. We're seeing a noticeable shift, with investors starting to look beyond the US. In fact, European, Chinese, and even Mexican markets have been outperforming the US recently. You might be wondering, what's going on with the S&P 500? Well, since Trump's inauguration, it's been relatively flat, although there has been some action within specific sectors. This brings us to a critical question. Why this outward flow of investment? There are a few key drivers. First, many investors perceive U.S. stocks, particularly in the tech sector, as highly valued, potentially even overvalued. This leads them to explore what they see as undervalued opportunities. Europe, for example, has been attracting attention. Building on that point about opportunities, China's recent market stabilization, coupled with their government's fiscal stimulus, has also made it a more appealing destination for some investors. Now, here is where things get even more interesting. One market strategist has suggested this shift could be a long-term phenomenon, even drawing parallels to the dot-com bubble burst. However, and I think it is very important to emphasize this, not everyone agrees with that assessment, especially considering the ongoing strength and innovation within the U.S. tech sector. Consider that perspective. That would be a personal recommendation. Remember how we just discussed investors seeking opportunities outside the U.S.? Well, that ties directly into our next topic. Microsoft and its evolving AI strategy. Initially, reports surfaced suggesting Microsoft was slashing its AI-related capital expenditures. Naturally, this caused quite a stir in the market. I mean, Microsoft is a major player, and any pullback from them signals potential trouble, or at least uncertainty for the entire AI sector. However, Microsoft quickly issued a clarification, stating they would still be investing over $80 billion in infrastructure as planned. So what's the real story? While they confirmed the overall investment, they did admit to potentially adjusting the pace in certain areas. Now consider that carefully, and that's where things get interesting. That clarification conspicuously didn't deny making adjustments to how they allocate resources to OpenAI. This leads us to an interesting paradox. You see, Microsoft seems to be aiming for a more neutral position in the cloud service market. Think of it as diversifying their AI portfolio. They want to be less dependent on OpenAI, and interestingly, are reportedly planning to provide more resources to Oracle. So, what does this all mean for investors? It hints at a significant shift in thinking. It appears Microsoft and perhaps others in the industry are starting to believe that the foundational AI model layer itself, the raw outgives, might not be where the big profits lie long term. But that's not the whole story. The real value, and therefore the competitive advantage, is shifting to the application layer of AI. This is where unique data sets and specific use cases come into play. Think about it like this. Google search. It's not just the database technology. It's how that technology is applied to organize and deliver information that makes it so incredibly valuable. That's the kind of defensible, profitable position companies are now striving for in the AI space. We need to observe in the next months how all of these big companies perform. And I think that is where we, as investors, need to focus our attention. We've been talking about shifts in investment and corporate strategy, and this leads us perfectly to Apple. Now, you might have heard some bold claims recently. President Trump asserted that Apple was on the verge of moving all its production back to the United States. However, and you know this is important to understand, Apple's own statement was, shall we say, a bit more nuanced. Let me be more clear. They avoided to say the whole truth. They announced a massive $500 billion investment in the U.S., spread over 4 years. A significant portion of that is earmarked for a new AI server factory right here in Texas. And that's not all. This investment also includes hiring 20,000 new employees, primarily in research and development, with a strong focus on AI. So we are looking at future jobs with a lot of opportunities. Imagine that 20.000 new chances for professionals, but, and this is a crucial but, Apple's official statement made no mention of pulling production out of Mexico. I want to emphasize this. Supply chain shifts, especially for a company as complex as Apple, are rarely simple or swift. They're like turning a massive ship. It takes time and considerable effort. What we're seeing is Apple diversifying its supply chain, spreading its bets, if you will, but it's not abandoning China. Finally, here's a question worth considering. Could this substantial U.S. investment be a strategic move to potentially gain some leverage in future tariff negotiations? It's certainly a possibility to keep in mind as we watch the situation unfold. One has to think what would be the real reasons behind that. Building on that point about Apple's potential strategic moves, let's turn our attention to the broader and frankly increasingly complex world of international trade, and that is where tariffs come in. Trump has definitively confirmed that tariffs on goods from Canada and Mexico will go into effect on the 4th of March. Or will they? An anonymous official, and take this with a grain of salt, suggested that these tariffs are actually contingent on ongoing border negotiations. So what does this all mean? We're in a period of significant uncertainty. Adding another layer to this, Mexico, in an apparent attempt to appease the U.S., is considering imposing tariffs on Chinese imports. This is like a game of economic chess, with multiple moves happening at once. All these increased tariffs, wherever they land, are undoubtedly going to further complicate the global trade landscape, impacting supply chains, costs, and potentially your investments. But amidst all this trade tension, here's a fascinating development in the tech sector. It has been confirmed that Nvidia has secured a whopping 70% of TSMC's advanced chip packaging capacity for 2025. Consider a situation where such a significant deal happens. 70% is not a small percentage at all. Now you might be wondering, why is this important? It's a clear signal of incredibly strong demand for Nvidia's chips, despite, or perhaps even because of, the global economic uncertainties we've been discussing. It would be important to follow up this situation. Now, shifting gears from global trade to the competitive world of tech, let's talk about a major power move. Salesforce and Google have joined forces, signing a significant cloud computing partnership. The goal? To attract enterprise customers, and more specifically to lure them away from Microsoft. This means Salesforce customers will now be able to use their software and AI products directly on Google Cloud. This is not a minor deal, and it will be important to follow this up. Salesforce is committing a substantial $2.5 billion investment in Google Cloud over the next 7 years. And it's a two-way street. They'll be collaborating on new AI products. Think of it as a combined force, leveraging their strengths to create a more compelling offering. So who benefits most from this alliance? While it's a win-win, I believe Google emerges as the significant winner here, further solidifying its position in the cloud market and opening up a new front in its ongoing battle with Microsoft. This partnership is something we'll be watching closely, as it could significantly reshape the competitive landscape of the cloud and enterprise software industries. From the alliance between Salesforce and Google, let's move to a starkly contrasting story, a significant stock plunge. We're talking about Hims and Hers Health, or Hims. The stock price absolutely plummeted, 18% to be precise. Now you might be thinking, what caused such a dramatic drop? It all came down to margins. Gross margins, specifically. The company reported 77%, while the market was expecting 78.4%. It might not seem that different, only 1%, but see it in the right context. It's important to put things in the right perspective now. For those unfamiliar with Hims, they've been a bit of a growth darling in 2024, especially known for their weight loss related products. They've carved out a niche for themselves by focusing on, let's say, sensitive health issues, things like hair loss and erectile dysfunction. So, while the company has been on a growth trajectory, this margin miss clearly spooked investors, highlighting the importance of profitability, even in a rapidly expanding company. And finally, in our company news segment, let's switch gears completely and talk about something that's generating a lot of buzz. Elon Musk's push for, shall we say, extreme efficiency within the government. It started with a rather unusual mandate. Federal employees were required to summarize their entire previous week's work in just 5 bullet points. Now, I am used to summarize things, but that is extreme. It sounds challenging, right? But here's the kicker. Non-compliance was treated as resignation. Yes, you read that right. If you didn't condense your week into 5 points, you were effectively out. Building on this, Musk also threatened administrative leave for any government employee who wasn't physically back in the office. This aligns with President Trump's executive order, which essentially eliminated remote work arrangements across all government departments. But here's the big unanswered question, and it's one that has significant implications for the economy and potentially the job market. Just how far can Musk and Trump actually go with this? Can they enforce large-scale layoffs? The legal and practical limits of their authority in this situation are, frankly, unclear at this point. It is a relevant question to make. This is a developing story, and we'll be keeping a very close eye on it, as the ramifications could be quite widespread. We've been discussing various power plays and political shifts, and that forms a perfect segue to what's happening in Germany. The recent German election has resulted in a victory for the Christian Democratic Union, or CDU, led by Friedrich Merz. But, and pay attention at this, the far-right alternative for Germany, the AfD, achieved its best result ever, becoming the second largest party in the country. This creates a fascinating and potentially volatile political landscape. I mean, consider the situation. This presents Merz with a significant challenge: how to form a stable coalition government. He's already definitively ruled out any cooperation with the AfD. So, what are his options? One possibility is a coalition with the Social Democratic Party, the SPD, and the Green Party. But such a diverse coalition could be inherently unstable with conflicting agendas. It would not be rare to have a complex situation. We have observed similar ones before, regardless of the final coalition. We can expect some significant policy shifts in Germany. Tighter immigration policies are almost certainly on the table, along with a renewed focus on revitalizing the German economy. One important point to note, and this has significant geopolitical implications. Merz is a staunch supporter of continued aid to Ukraine. Germany's decisions in the coming months, particularly regarding Ukraine, will have a profound impact, not just on Ukraine's survival, but on the overall unity and stability of Europe itself. We must pay attention to the developments in Europe and how Germany is positioned in it. We've been examining the ripple effects of the German election, and this naturally extends to a crucial debate about Europe's future security posture. Essentially, Europe stands at a crossroads facing two distinct paths. The first is strategic autonomy. Think of it as Europe taking full control of its defense, building a dedicated European army. The second path is a more familiar one: strengthen cooperation within the existing NATO framework. Now, you might be wondering, what are the implications of each? Well, the European army concept, while appealing to some, comes with a hefty price tag. Building a truly independent military force requires significant funding. And that's a major hurdle, given the current economic realities in many European countries. It is not easy to picture this happening given the current context, so here is a potential near-term consequence. Even if Europe commits to increased military spending, that money might initially flow towards purchasing US weapons and equipment. It's a practical necessity to bridge the capability gap. But that's not the whole story. Here is a parallel development underway. The UK and France are actively working on a plan for a European security force. We're talking about a rapid reaction force, potentially up to 30,000 soldiers, that could be deployed to Ukraine, for example, under a peace agreement scenario. However, and this is a crucial point, the UK Prime Minister himself has acknowledged a stark reality. This force as envisioned simply wouldn't be operational without the backing of the United States. It begs the continued importance of the transatlantic alliance, even as Europe explores its own defense options. I have a question for you. Where will Europe be heading? So, we have talked about several topics. We discussed a lot of corporate actions, but from corporate earnings, let's transition to the broader market outlook, and specifically, what one legendary investor's actions might be telling us. We're talking, of course, about Warren Buffett and Berkshire Hathaway. Now, Berkshire's fourth quarter earnings were strong, exceeding expectations, and that was largely thanks to their insurance business. But here is something to think about. It was not the earnings themselves that grabbed headlines. It was what wasn't, said Buffett's annual investor letter, usually a source of wisdom and market insights, was remarkably quiet. It provided very little in the way of guidance or commentary on his current view of the market. Now, you might be thinking, so what? Well, consider this. Berkshire hasn't repurchased any of its own stock since May of 2024. That's a significant pause, and it strongly suggests that Buffett, the ultimate value investor, believes Berkshire Hathaway's stock is currently overvalued. He's not buying at these prices, and that leads us to a critical question. A question that's sparking a lot of debate in the market right now. What is Buffett waiting for? Is he simply anticipating a normal, healthy market correction, the kind we see periodically? Or, and this is the more unsettling possibility, is he bracing for something bigger, a more substantial bear market? That is a doubt that has been presented in the recent comments. The truth is, we don't know for sure. Buffett's silence is open to interpretation, but his actions, or rather his inaction, speaks volumes. It's a signal, at the very least, to proceed with caution and perhaps to reevaluate your own portfolio's risk exposure in light of the current market conditions. Remember, that would be a personal suggestion. We've just explored Berkshire Hathaway's cautious stance, and that provides a fitting context for analyzing a specific stock that's been making headlines, Tesla. Unfortunately, it's not good news for Tesla bulls. The stock has decisively broken through a key support level. What does this mean? Simply put, it's back in a downtrend. Any upward movements we might see in the near term should be viewed with skepticism. They're likely just temporary rebounds within a larger downward trajectory. I am not very optimistic about this one, so, Bobu, here is the next potential floor. The nearest strong support area lies between $241 and $280. But that's not the only headwind. Key here is a growing wave of negative sentiment surrounding Elon Musk, and even some talk of potential boycotts of Tesla products. All of this could very well put further downward pressure on the stock. Now, a word of caution. While the chart looks bearish, I generally advise against shorting stocks, especially one as volatile as Tesla. Why? Because short squeezes, those sudden sharp price spikes, can be incredibly painful. You get forced to cover your position at a loss, and it can happen fast. It's just not worth the risk, in my opinion. It is best to let it be for now. From one volatile stock to another, let's shift our focus to a company that experienced a truly wild ride recently. Unity Software, I mean. This stock surged a staggering 30% after what I can only describe as a roller coaster of an earnings report and conference call. It was a day full of emotions. Initially, things looked grim, but then, boom. So what happened? Well, their fourth quarter revenue did beat expectations, but, and this is a big but, there was a year-over-year decline. However, that decline is a bit misleading. It's mainly due to Unity's strategically shedding some of its non-core businesses. They're streamlining, focusing on what they believe will drive future growth. It is never easy to picture the future now. Here is where it gets interesting. Their guidance for the first quarter of 2025 was, frankly, weak. And why? Because they're undergoing a major transition. They're shifting to a brand new AI-powered advertising platform called Unity Meta. The aim of Unity Meta is crystal clear: to drastically improve ad targeting and, crucially, to go head-to-head with a major competitor, AppLovin. Now, this transition to Meta is a calculated risk. It will negatively impact their short-term revenue and profitability. But, and this is what got the market excited, the long-term potential of Meta is significant. The timing also played a role. You see, a negative report about AppLovin surfaced right around the same time, further boosting the positive sentiment towards Unity's new strategy. I think it was greatly beneficial beyond the advertising platform. Here is more good news. Unity has successfully addressed the issues surrounding its rate fees, and we're seeing increased adoption of Unity 6, their latest engine. And they're not just holding their own, they're maintaining a dominant market position in mobile, PC, and even AR VR game development. Just consider this as an example of how well they are doing their industrial business. Catering to sectors beyond gaming saw revenue grow by an impressive 50% in the fourth quarter, and they're landing big-name clients like Toyota and Raytheon. So what's the bottom line? Unity's future, and therefore its stock's success, hinges on one critical factor: Meta's ability to claw back market share from AppLovin. It's a high-stakes battle, and one we'll be watching very closely. It is very important to ensure the long-term sustainability of the business. We've covered a lot of ground today, from major market shifts and company-specific news to Julie events and stock analyses. It's clear that the world of finance and investment is constantly evolving, presenting both challenges and opportunities. I hope this video has provided you with valuable insights and perspectives. And remember, that is the goal of this channel. Now, I'd love to hear from you. What are your thoughts on the topics we discussed? Which companies or market trends are you most interested in right now? Please share your opinions and questions in the comments below. Your engagement helps shape the future content of this channel. If you found this video helpful, please give it a like and subscribe to Collin Investing for more in-depth analysis and financial insights. And of course, share this video with anyone you know who's interested in staying informed about the world of finance. What other financial news are you interested in? Let me know, and I might cover those topics in the future videos. Thank you for your time, and I will see you soon.